everyone. Thank you for joining us for today's webinar, Can Economics Predict the Outcome of a Presidential Election? We certainly have quite a bit of uncertainty here in the next week or so. We have a lot of factors that will affect the election and the markets, and we're happy to present an economic view on possibly, some things that you want to be considered when investing in a presidential election year and an election. So we're happy to have Mark Shug, the professor. So he has done previous demonstrations, presentations for us before, and we're happy to have him back for a new exciting topic that's very relevant and most people are very interested in. We'll just do a very quick disclosure before we get started here. This presentation is for informational purposes only. Nothing presented today should be construed as investment advice or recommendation to buy, sell, or hold any security or contract. We don't know everyone's investment strategies, investment objectives, or risk tolerance. We're not endorsing any specific trading strategies. Security, derivative, and futures trading involves substantial risk of loss, is not suitable for all investors. Each investor must consider whether this is suitable investment, since you may lose all or more than your initial investment. Past performance is not indicative of future results. Lightspeed Financial Services Group, LLC, is not affiliated with those third-party market commentators, education service providers. Data, information, and material, this content are provided for informational, educational purposes only. Content should neither nor should be construed as an offer, solicitation, or recommendation to buy or sell any securities or contracts. Any investment decisions made by the user through the use of such content is solely based on the user's independent analysis, taking into consideration financial circumstances, investment objectives, and risk tolerance. Lightspeed Financial Services Group and Lime Brokerage LLC does not endorse nor recommend any of the services or commentary provided by any of the market commentator educators or service providers, and any information used to execute any trading strategies are based on the independent analysis. Okay, thank you. For more information on a demo for the software, open an account with Lightspeed, please contact us here. My name is Rob Lipson. You can contact me at rlipson, RLIVSON at lightspeed.com. Feel free to call or email. Also sales@lightspeed.com. We're happy to assist. Okay, so we're happy to have Mark Shug here. I'm going to make him the presenter, and we are certainly going to get started right away. Thank you guys for attending, and just hold on one moment as we make the quick adjustment here. Okay, Mark, please, if you can share your screen here.
Can you see it?
Great, yes, we can, and we can hear you.
All right, well, welcome everybody. The formal title of the presentation is Presidential Elections and Markets, What Factors Should Investors Consider When Investing, and Can Economics Predict the Outcome? My name is Mark Shug. As Rob indicated, I'm an emeritus professor at the University of Wisconsin-Milwaukee. Emeritus means that's kind of an honorific title. It means I basically retired there in fairly good standing, with like a C+. And maybe it takes a B to get emeritus, I don't know. But anyway, I actually live in Port St. Lucie, Florida, and that's where we're coming from, in a nice warm day today with puffy blue sky with puffy white clouds out there. So it's a very pleasant day. So let's get along with the topic. So this is what we're going to talk about. What's the current economic scene? And I'm going to show you some stuff that nobody's ever seen before in terms of some statistics, some charts. So we'll have some fun going through a few charts real quick. How do investors behave during a presidential election? So what have people in the past sort of done? We're going to talk about some factors that you might consider in this current presidential election year, and looking a little bit into the past. And then, I don't know, I'm guessing that many of you are younger folks. You might not remember the misery index, but this has been around for quite a while. This goes back to President Ronald Reagan's era and President Jimmy Carter's era. And it's been used for many years by economists to predict the outcome of presidential elections. And most time it is right, like 9 out of 10. But there's also another interesting thing called the Iowa election market. And this is a futures market where people actually bet on, bet real money on what the outcome. This is not like in England where people can bet a lot. This is a very restricted market, but it's very interesting. Then we'll do a quick review, and I'm going to try to keep an eye on the chat, and maybe Rob, you can help me a little bit, and we'll do the questions through chat. Although we certainly, oh well, we've got quite a few people, so it'd be hard to do it by having you unmute. So the current economic scene. Here we go. Well, my goodness, we are in a recession. We are in a pandemic. There were street protests in Philadelphia last night. We recently had the swearing in of a new Supreme Court judge and a presidential election all going on at the same time. Now, that seems like quite a boiling pot of uncertainty. And stock markets, by and large, don't like uncertainty. By and large, the markets like things to be predictable, and then they behave in a predictable way. Well, here are some numbers you have never seen before. In addition to all that stuff that we just talked about with the Supreme Court and the presidential election and the pandemic, this is the last report for second quarter GDP, 31% decline. So the Bureau of Economic Analysis didn't even wait around. Normally they wait 2 quarters. Well, you see 2 quarters of negative growth now, but they called this as a recession in the first quarter. So you see this is negative by a ton. All right, so this is a very big decline in GDP because, right, we closed down the economy. And when the economy closed down, of course, GDP is a measure of economic activity, of production. Oh, this screen is, I'm gonna see if I can move this over a little. Okay, it's not, I think part of the screen is sort of hidden from you. So I'm kind of hesitant to, no. Well, what you see here is this big dip down, and it continues to go down like this, and then it kicks up a little bit. And so let's see, what if I do this? Here, if you see this, it goes all the way up here, and then it goes all, this is nearly 15%, and then it goes all the way down there. I mean, talk about a roller coaster. This is unemployment, right? And I'll get the big screen on again in a second here. But this is job claims. Look at this. Oh my goodness. And then it comes, you know, right after March, it comes rolling back. Let's see, I'm going to have to put that up to see what that slide is because I don't remember. So that was initial job claim. Oh, this is the S&P 500. Well, you can see this one. And so you see this, whoa, look at that. I mean, the markets just fell apart in March. And this is interest rate. So look what happened here. You see right here? Well, let's see, I'll minimize it again. Let's get over to the interest rates. Here you go. So here's the Federal Reserve raising interest rates. And then this is where we are right now, dropped right back down. And this slide is going to show you the S&P today. All right, and it's going to show it closing lower, but this is where we were in March, and this is where it is today. Now, admittedly, all the markets were down today, but when you look at this whole scene, you think, oh my goodness, you know, with all this uncertainty, shouldn't the markets be getting hammered at this point? And they certainly have been hammered the last 4 days, but nowhere near where we were in March. So what might explain, at least for this period here, we know what's explained right now. We've got 2 things that are really going on. First is that the Congress did not pass a stimulus package. The president and, well, the Treasury Secretary was negotiating with Nancy Pelosi in the Congress, the House of Representatives, to come up with a deal. And they failed to come up with a deal. So that's dampened the enthusiasm in the markets. But the other thing is, of course, the expansion of corona cases has got people spooked. So this is where we sort of are wondering. Now, you saw in these graphs what a radical shift, boom, back up. Okay, so is this going to be a boom back up? So is this GDP collapsing and returning almost immediately to where we were in January of 2020? Or is it going to be a U-shaped economy where we'll return, but it won't be soon? And are there other negative factors? For example, the second stimulus package didn't pass. So that may be something that's concerning. You get an immediate bump from that sort of a stimulus package, but that's what it is. It's an immediate bump. The long-term situation isn't so bright because almost all that money, bonds have to be sold to cover the deficit, which adds enormously to the national debt, which eventually puts big pressure on interest rates. Or is it, as it implies here, a K recovery, where some people are getting a V recovery and other people are getting a U recovery? So let's sort of look at this. Now, this is from the Atlanta Fed. And they are saying, now, third quarter GDP comes out tomorrow. So I thought, well, let's see what the Atlanta Fed is predicting. They're predicting a 35% increase in GDP. So we said, I believe back there that it went down 31%, coming back to 35%. That would mean the recession is over. So it could be that we're out of recession, barely. But it could be that the economy is ever so slightly growing. And so when GDP is positive, then we say the recession is over. So maybe the markets are focused on this, that GDP is going to get better quickly, and they're focused on a V sort of recovery. Now, or what about this K? Well, this is how I'm thinking about it. There are a group of people out there that have done just fine during this period, and I'm calling them the pajama people. Now, I'm not wearing pajamas because I wasn't sure if we'd be live, and maybe I'll turn on my live screen at the end. But the pajama people are the folks who are better educated. They can work from home. That's the main thing. And who works from home? Typically, those are better educated people. They're less negatively affected, and some of them may have even done better. I mean, my professional life is maybe in some ways better. I don't have to travel as much. And now, through the magic of GoToWebinars and Zoom, I'm still doing a lot of speaking these days without having to leave my office, which is kind of nice. So people who can work from home have kept their jobs by and large. And these are people in information management and professional services, in technology. Those sectors, people working in those sectors have done reasonably well during this period. Who have not done well? Well, I'm calling the apron people. These are the people that have to show up to work, right? I mean, and they tend to have high school diplomas, maybe some technical education, but they work in the hospitality industry, casinos, theaters, restaurants, cruises. I'm coming to you from Florida. The tourist industry has been knocked on its can here. Disney was closed, and they're opening very slowly. And so the apron people. So maybe the markets have their eye on the apron people. Well, they have their eyes on the pajama people, and saying that that's a reason to have some optimism about the stock markets. Now, I want to go back to this third bullet here. The situation also varies quite a bit by region. This is separate from the apron people. Some states have opened up successfully and some states have not. I'm coming to you from Florida. Our cases are growing here too, but not as rapidly as some other states. So per capita, Wisconsin is growing very fast. They're opening a couple of emergency hospitals there in the Milwaukee area. So that's part of it too. So in the Sun Belt probably can open easier, whereas the colder regions now are going to spread the virus because it looks like a cold winter and people staying indoors. That's not going to help any. And so I think that's part of the reason, at least. Look, I'm no doctor or anything, but that does appear to be one of the reasons are commonly mentioned. Another thing that the markets might have the eye on is the Fed was very quick to take action. Jay Powell left no doubt that he was going to move swiftly, and he did. They lowered interest rates. You saw the graph. They lowered interest rates almost immediately, and they said they're just going to stay down for a long, long time. So, those people that are in bonds, of course, this is no fun, these low rates. And so the only place you can really go is stocks to get any kind of a return. So this is, we worry later on down the road, might we be causing some bubbles to form in the markets again. But this is a fact that interest rates are low, and the Federal Reserve took several other actions in terms of lending, opening up its lending capacity. Never before in history has the Federal Reserve provided loans to businesses. This has never happened before. So this is a breathtaking change that the Fed did, and almost certainly the markets felt some relief as a result of that. So maybe the markets are focused on low interest rates induced by the Fed and the other emergency actions, these emergency loans that the Fed provide. All right, so next topic. How do investors behave during a presidential election? This should be kind of interesting. So since 1992, people tend, I was having lunch today with a good friend of mine, very successful investor, and he's moving a lot into cash, all right? And he plans to come back out. So a lot of people move assets into money market accounts or other safe investments while waiting the outcome. But there's some risk and reward here, right? People who get out of the market entirely tend to get burned. So you have to look at this, I think, very carefully. So that's what people tend to do. Now, the question is that smart thing for you to do? Obviously, we don't know your risk and reward calculation, so you'd have to think about that. But just a quick reminder, in the walk up to the November 7th election in 2016, there were all kind of media reports that Donald Trump, if he would win, which was, of course, a shock to all, that there'd be an instant recession and a stock market crash. Well, there's still some of the talk out there of, that things might go badly very quickly if a Mr. Biden was elected or if a President Trump was reelected. So just for the books now, just for the record, between 2017 and 2019, average annual price return for the S&P 500 was over 14%. So maybe a smart thing to do is to avoid panic, remain in the market, and keep an eye out there for good buying opportunities. As Warren Buffett says, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And there might be some wonderful prices out there just now, given where the markets have gone in the last few days. And so we are certainly seeing price fluctuation leading up to the election. However, in this case, I think it has more to do with the corona cases than it does with the election itself. We did see volatility last round, though, in 2016, just before and just after. So the Chicago Board Options Exchange, the CBOE, has this volatility index. And so you might want to just click on that particular link and see what the volatility is over the next few days and see if that provides you with some sort of opportunity. Okay. And the other thing to consider is that not all sectors are created equal. So if you look at the various campaign platforms, the Democrats developed a brand new platform. Republicans just rolled over the 2016 platform to today with a few tweaks. Some sectors might face some more volatility than others. So healthcare sort of stands out. Now, the Democratic Party platform calls for expanded healthcare with a continuous, with maybe some revisions to the Affordable Care Act. They've talked about some expansion of Medicare to more groups. If that would happen, it might create some uncertainty in the insurance industry, but it's generally an increase in demand for healthcare itself. And another factor that's affecting healthcare right now is that many hospitals. I saw a doc face to face. Yes, I did. I saw a doc last week face to face. My prior appointment with a doc was on Zoom. So the hospitals and so more care is opening up. Therefore, people are having more procedures. Therefore, healthcare companies, not necessarily insurance companies, but healthcare providers could see their situation improve in the short term here, depending on what happens with the Affordable Care Act. Others are energy. The Democratic platform has called for a moving away from fossil fuels. So, the oil industry's had a tough go anyway. So there could be some changes there. And then we had testimony just today regarding the big tech companies. And so there has been an expression of interest on the parts of both parties about the influence of big tech. So generally, tech stocks have done very well during this period. They would be part of the pajama industry, I think. But they could face some uncertainty down the road too. So I keep an eye on tech in terms of some volatility there too. So these sectors, energy, big tech, and healthcare sort of stand out. They might represent some opportunities for you to look at. Okay, some other factors to consider regarding the markets. Okay, so first, we're electing a president. We're either going to keep the incumbent president or we're going to elect a familiar figure in former Vice President Joe Biden. I think the media overstates the influence of the president in the economy. The president is not the commander-in-chief of the economy. The president is not the economy. The president is the commander-in-chief of the military and can do a lot there. But the economy is very complicated. It's driven by, the U.S. economy is just vast. I mean, vast. It remains, I believe it still remains the largest economy in the world. China is very close. Per capita wise, the United States economy is huge. I mean, per capita, if we take total GDP and divide it by the population, China's not even close to the size of our economy. So this is a very complicated economy. The economy in the Texas area is very different from Florida, which is very different from Vermont, which is very different from Washington State. So there's a lot of variables, there's a lot of regions, it's a big country with a lot of industries. So just changing the presidency doesn't necessarily mean everything collapses, right? Or everything goes up. And if you're concerned about particular policies pursued by any president, regardless of party, is usually a lot of steps involved. Now we know that Speaker Nancy Pelosi and President Trump both wanted to get some kind of a second relief package out there, but they couldn't agree, right? And largely because Republican senators were reluctant to do more of this, $1.5 trillion kind of spending to add to the national debt. It adds first to the deficit, and then that deficit gets rolled over to the debt. So you got to get 2 houses of Congress. It has to be approved by the president, and it has to be constitutional. And all that involves interest groups and all kinds of things going on, especially the legislative process and the executive process involves lots of people trying to influence that outcome. So just changing the presidency doesn't necessarily mean that you're going to get a whole new ball game. Historically, markets have done well over the long term, regardless of which party has control. And the business cycle typically is longer than any one presidential term. So I say take a breath and then look at this chart. Okay, you can see here that during Republican as well as Democratic presidencies, the overall trend of the market is up. And I'll just minimize this so you can kind of see right up to the end here, right? So this is Mr. Trump's administration right here, President Trump. And this was President Obama. Biden. That's interesting. I just made up a new presidential word. This is the Bush administration. So you can see that if you were to even this out with a straight line, that the direction is clearly up. Okay, let me put this back. So, and then a lot of other things to consider. Who or what will voters blame for the current recession? Now, we're in a recession today. Tomorrow, we might not be, but we certainly experienced a huge collapse of GDP. So, the research says that every president who did not face a recession during the 2 years leading up to the election won re-election. The one exception was Cool Cal Coolidge back in 1923. In 21 and 22, there had been under Warren Harding a recession, a very deep recession. And you don't remember anything about the New Deal that created by Calvin Coolidge because he didn't do anything about it at all. The economy came back, and he was elected president. He became president in 1923. That's when the incumbent president died from a massive heart attack. GDP growth was solid in the first 3 years under President Trump. But clearly when the government closed the economy, so I have a friend who calls it a repression, not a recession, because it was repressed through government power. It was no market force that was causing the recession. So will voters how will they view that recession? Now he's taking a recession at probably the worst possible time. But will they blame the president for the recession? Will they blame COVID and perhaps the president's handling of COVID? Will they blame China or will they blame the World Health Organization? If they blame Trump, according to the historical research, he doesn't have a prayer. There is evidence which suggests that short-term performance of the markets might predict the outcome. A rising S&P 500 in 3 months leading up to the presidential election is associated with the incumbent winning, and that's what we've seen, except now walking directly up to the election, the S&P 500 has been down for the last 4 days. But over the last 3 months, it would be up. So again, it feels so weird that there are so many things that are off track just these few weeks and days before the election that makes it just very hard to know where the economy might be headed. Markets tend to perform less well when there's a change of administration. So in the short run, and we've been talking a lot about the long run, there might be a little slowness right after the election, especially if there is a Biden-Harris administration comes into power. There's certainly going to be uncertainty about taxes. The Democratic platform calls for some big changes in taxes. They call for big changes in regulations. They talk about the possibility of both parties talk about breaking up big tech. There may be some anti-private sector attitudes in play. And so there could be some slowdown following it. But if you go back to our original chart, this guy still would give you some confidence that we can have some confidence that the market will perform well under either a Biden administration or a Trump administration. Okay, well, this part is meant to be just a little fun. I know, I'm an economist, right? To me, this is fun. I'm getting near the end of my formal part of the presentation. So if you've got questions, maybe you want to start getting them into the chat. Okay, so here we go. There's an economist who's passed away several years ago named Arthur Okun, and he developed a statistic called the misery index back in the 1960s. And the misery index is a really simple calculation. It involves adding the unemployment rate to the rate of inflation. And back in the 60s and the 70s, there was a lot of inflation. The inflation doesn't end until the Federal Reserve raises interest rates around 1979 under Paul Volcker, which really we see it today with the very low levels of inflation, and that happened back 79, 80, just between the Carter and the Reagan administrations. So it's the misery index. I think today the unemployment rate is probably more important than the rate of inflation. So the idea, though, at the time when Okun was doing this was to think, well, how is the economy really affecting just the average people out there, right? GDP is just this, kind of, what would you say, kind of broad statistic that really doesn't feel like it affects anybody. Whereas unemployment and inflation, yeah, people go to grocery stores. They notice when prices go up. When you lose your job, yes, you notice that. If we dip into a slight recession, that's far less noticeable. So if the misery index declines as an election year approaches, it predicts that the candidate of the incumbent party will keep control of the White House. This, just putting those two statistics, this has predicted the outcome several times correctly since 1980. So a high or climbing misery index usually results in a change in the incumbent party. A falling misery index usually results in the incumbent party remaining in power. So here's how it looks. And so you can see, now this is what I was just describing. Here's 20%. Can you imagine that? 20% is the misery index. So some of that's unemployment, but back in 1980, a lot of that was inflation. Well, it would be no surprise that Mr. Carter would not be reelected. He had one of the worst going misery indexes that you could think of, right? And Carter, and then if we look today, again, I'm going to minimize the slide again so you can see. All right, so I'm trying to point to this is where it went in March. So let me put the big screen back on again. So here's where it went in March, 15%. And that's mainly unemployment. That whole thing is pretty much the unemployment rate. And now the unemployment rate has dropped to below 10%. So look at the yo-yo we just went through here. So here, the Trump administration is starting with a misery index of about 6%. All right, under this 10% range by a lot. So it's right here. And then it goes to here in March, which is just horrible territory, right? Look in the past how often we've been above 15%, but then it came right back down. So how are voters going to look at this? The misery index would predict this is not good for President Trump because, but what are they going to look at? Are they going to look at this, or are they going to look at this? So this is why it seems this year everything is sort of just hard to know. And here shows the parties involved. So here's back to Carter and Reagan, right? So look at this baby. So when Carter was just finishing his term, it was at 20%. It was declining, but still through the roof, right? Here we see a change in office here. The much lower misery index, but see, this is the thing. It was increasing pretty dramatically under the Obama administration. So, unemployment never got all that low during the Obama administration. It was coming down. And a little bit of inflation, and that's where he winds up. And this is the Trump administration. And whoop, there's this guy. That's a technical term. Whoop, it goes up here and then goes there. So are voters going to remember this, or are they going to remember this? So there it is, folks. I wish I had a better answer for you, but I tell you what, you guys are all, well, so here's where we are right now. We are at 9.2. Inflation is at 1.3. Unemployment rate last reported was 7.9. And so the current misery index is 9.2. What does this mean for President Trump or former Vice President Joe Biden? You just looked at the graphs. You know as much as I do now. It just depends on who they're going to hold responsible. So that just seems to be the thing. Who are voters going to hold responsible for the current economic scene? Is it increasing fast enough? But then you've got, what's the number? There's been like 70 million people have already voted. So even if this continues to come down, they can't go back and change their votes. Okay, so now this is something I'm pretty sure you've never heard of. This is called the Iowa electronic market. And this is used a lot in higher ed. It's used for some research. And what it is you can go and buy a futures contract using real money, not much, $5 to $500. So if they went much higher, they would come under SEC scrutiny. So they keep this pretty low. And so people that can trade corn futures, well, the IEM allows people to trade vote futures. And so what they like to compare themselves to are polls. So when people are buying, basically future contracts, when they're putting their money on the line, not just somebody calling you on the phone and asking you something. That's the real criticism of polls. Economists aren't so crazy about polls sometimes, because somebody calls me on the phone and I say what I think, or but you don't know what I'm going to do, right? And that's the criticism these days about the current polls that show President Trump behind almost everywhere, certainly nationally, and in many of the real close states. But what we're not sure is, are the people responding to the poll questions, the survey questions, are they being honest? Do they not want to say that they support Mr. Trump when in fact they do? And so, can a futures market, which involves real money on the line, outperform polls? Well, if you go to this website, you go to the IEM, and you can poke around, and by and large, the research says yes, that it seems to somewhat better. Now, this is what the outcome looks like. So I'm using the Democratic nomination first, okay? So here's the early primary days. And by the way, we haven't really mentioned it because it's too late to think about it now, but just going forward, if you're looking for real volatility during a presidential year, this is when you tend to see more volatility in the markets, not out here when we're very near election day. Back here was the primary period for the Democratic Party. And you see, let's see, this is Bernie Sanders, right? So pretty soon you could buy a contract on Bernie for like $1, because the people in this market didn't believe he was going to win. But after South Carolina primary, boom, this is Biden, right? So here's Biden, the blue one. This is Elizabeth Ward. And so you see her collapse, all right? But here's the main one, is Mr. Biden, and boom. So you see they were paying a lot. So the bets were over $80, $90. So at one point you could pay $100 and only $99 only make $1 on this, right? If you bought down here, you probably would have done better. If you bought down here and held, you would have done very well. You would have been buying Joe for $20 and be able to sell for $100. So they did an outstanding job picking the Democratic nominee. How are they doing in the presidential election? This is President Trump. This is Mr. Biden, former Vice President Biden. So what this is showing, and I did this on Monday, this is actually showing a tightening. Okay, so they're saying you can buy Biden for about $60, maybe $55, and you can buy Trump for maybe about $45. Now that's still a pretty big gap. So this certainly looks like Mr. Biden is going to win, but it isn't quite as a landslide as you might think. And plus, who knows where this is a week from now, or slightly less than a week from now, on November 3rd. And as we progress with the early voting. What about the House? Well, here, I'll minimize this so you can take a closer look. The black line, this line is the one of interest. This is saying Democrats gaining seats in the House of Representatives, okay? Okay, let's see. You see where it goes? It's way up there. So it appears, according to this market, a dead certainty that that the U.S. House will, that the members of, will have more members of the Democratic Party, not less. And so they will maintain control of the House. and Nancy Pelosi has also expressed interest in continuing on as speaker. So that they have to decide all that, but the odds look good that that's how things would go. What about the Senate? The Senate, the Republicans are defending a great many seats, and so back here in the earlier part of the year, the Republicans were looking like they were going to hold their seats, looked very good. And then the wheels came off. Look at this blip. I don't know what happened here in September, that suddenly people thought the Republicans were going to gain more or hold their large number of seats. And the blue line shows the loss. So here the losses are very high. So I'm going to minimize this again so you can kind of just see the rest of the picture. So here it is right here. So this is a pretty wide gap. And I think this predicts that the Republicans will lose the House, or excuse me, the Senate. So according to the futures market, the White House race is still a little close, but clearly Mr. Biden has the lead. The House, there's no question, according to this market, not a survey, not a poll. According to this market, the Democrats expand their lead, and according to this, they get the Senate. Okay, so once over lightly, the current economic environment is unprecedented. That's for sure. Since markets dislike uncertainty, it's hard to discern why they have been generally upbeat, except for the last 4 days. And we see evidence for a V recovery. So that's the Atlanta Fed's prediction about what we're going to hear tomorrow. But also we see maybe the K recovery, where some parts of the economy have not been hurt too badly, and other parts, like the tourist industry and restaurant and that kind of thing, has been hurt badly. Now, investors tend to turn to safer investments in the walk up to a presidential election, but leaving the market completely probably has negative consequences. So you need to weigh the costs and benefits, the risk and reward in that situation. Perhaps it's best to hang in here and continue searching for good companies. There is also likely to be a little more volatile, and we're certainly seeing volatility right now in the overall indexes as we get closer to the election. The president is commander-in-chief of the military, not the economy. And so even if there is a change, well, I think we have a good idea where President Trump would go. We know what former Vice President Biden has talked about. But my point is that the way the Constitution structures the United States government is that the president just can't do everything on his or her own, that they face 2 houses in Congress. They face all kinds of pressure from voters. And so it's not like they can just do whatever they wish to do. Over the long term, the trend of the stock markets is up regardless of which party is in power. A recession this close to an election is rare and almost certainly hurts incumbents. And so we've taken on a big recession, very, very close to the presidential election. So it really depends on who voters are going to blame for this recession that clearly was induced not by markets, but by a government authority, government power. And can economics predict the outcome? Well, the misery index is spiked and is dropping. But will the drop be enough to favor the incumbent? And usually it's like so close to the election, you tend to think not. And the Iowa electronic market is pretty clear. The Democrats win Congress and probably the presidency, although that's a little bit closer. So I'm starting to wrap up, and we're 45, just about 42 or 3 minutes into the presentation, and we'll start looking for questions. And maybe Rob, you can help me a little here. But so this is going to be December 9th. If you want to come back, and we're going to be looking for. Maybe we'll show some of those first slides again and just update them. But what forces are pointing to a strong or a weak recovery in the economy and in the markets in 2021? So we're going to do a little recap of 2020, and then we'll be taking a little look forward. We'll be looking at stocks. Housing's been strong through most of 2020. There was a little dip the other day. How has manufacturing been doing? How is GDP doing? What about consumer confidence? What's the unemployment rate look like? What sectors performed well in 2020, which performed poorly, and we'll try to use a little crystal ball to try to anticipate what might be going on in the future. If you want, let's just leave this slide up for a minute. I'm updating my website right now, but the old one is there and it has some contact information. So you just put my name into a Google search. I'm literally in the middle of updating the site, but it's got my contact information. You can get a hold of me there. This is my email, mschug@University of Wisconsin Milwaukee, uwm.edu. If you'd like a copy of the slides, just I know that you can get it online, and you can go to where is it? I think you can go to YouTube to get it. But if you want to get it from me right away, you sure can. So there we go. So we're going to open for questions. Now I'm going to minimize this, and I'm going to see if I can get out of that. And I'm going to put on my camera and see if I come on. I believe I did. Okay. So Rob, are you seeing the chat? Okay, I'm looking for the chat.
Rob had to step away for a minute.
Okay.
I can see the chat though. I can read some questions for you if you'd like to field those now.
I would, and if I'm not. Oh, here's chat. Hold on, maybe I can pull them up. Okay, here. All right, why don't you read them to me? I'm not being able to get in there right now.
Sure. Yeah. So Victor Sabo, and excuse me if I butcher your name, would like to know what a Czech company is.
Oh, well, I'm thinking of the regular big tech companies. I'm thinking of Amazon, Google, Facebook, Twitter. That's what I'm thinking about, but not just that too. I mean, the overall technology industry has many little grooves in it, and so generally I'm thinking of those big tech companies. But there are any number of other related firms, chip manufacturing and so forth has been changing quite a bit. So I'm generally thinking about the big boys.
Thank you for answering that. I have Naveed Akar said, thanks for the great presentation, loving it. I've started day trading since February 2020. I've seen that there has been great volatility, especially to the penny stocks. I'm wondering if this is always the case, or is it going to be slow after the pandemic is over or the election is over? Thanks.
I think you hit it right the first time. I think penny stocks are always a volatile area. That's a risk and reward kind of area. The risks are a little bit higher, but the rewards can be awfully high too. So I think that sector, the penny stock operations, would continue to be volatile. I don't see how it changed in, what do I know? But I don't see how it changed in the whoever's in the White House would affect that very much.
Okay, thank you very much for answering his question. Next, we have a Joel Dorr. Excuse me. I'm sorry again if I butcher anyone's name. He is asking, how come deficit spending was never mentioned for assessing economic strength?
How come deficit spending
was never mentioned for assessing economic strength?
Well, that's a good question. The deficit, people view deficits a little differently. There are some economists that think some level of deficit spending is okay. Probably most economists think some level of deficit spending is okay. But when you're adding $2.5 trillion to the national debt, that's a different critter. GDP now is smaller than the national debt. GDP, we would have to produce goods and services for a whole year. Now, nobody wants to pay off the national debt. It just say the last time we were in this situation, we were not even in this situation during World War II. All right, so what happens is Treasury has to sell Treasury bonds in order to pay the bills, right? Just because we're spending more money, we have to find that money somewhere. So we have to go in to the loanable funds markets and sell bonds and hope to goodness that people will buy the bonds. But as you get into this territory of a very high level of deficits, and remember, deficits are just a temporary thing, then they roll into the debt, eventually interest rates start to rise. And then the whole problem compounds, because right now, treasuries are at a very low interest rate, but the higher risk your economy looks, investors are going to demand a higher interest rate. And as that happens, then the interest rates start to rise. And then the federal debt is even more difficult to deal with because the interest on our debt becomes very high. And that starts to crowd out funding of other essential areas of government. So the trouble with the advantage of a stimulus package, the first one that we had, and the advantage of a second one, if it had passed, is a lot of money flows through the economy quickly. And a lot of people are helped by that. So businesses get money to help pay their employees during this period of time. Individuals get more help in unemployment if they've lost their jobs. All right, but the problem with that is it runs out, and then you have nothing to show for it except the debt. So I think economists would agree that a better scene would be to have a carefully opening economy. And I think we've learned that just shutting the economy down hasn't slowed the virus. And so we need to carefully open, social distancing, masks, avoid big crowds, all that common. And if you're my age, you want to kind of avoid some crowds and things, right? If many of you are much younger, maybe a little less worried about things, so we have to very smartly and carefully open the economy. And so that brings the economy. That's why you saw that unemployment rate drop so fast, and you saw job claims drop so fast. That's Texas and Florida and other states opening up again, where other states remain. Wisconsin's getting ready to lock back down again. So I hope that addresses it. I know that it has not reported widely, and that's why you come to these things, is to hear that. It's not just a slam dunk that a stimulus is a good operation. It comes with costs and it comes with benefits. And so investors should always be paying attention to the costs and the benefits of any decision they're making. Okay. Anything else out there, Rob?
Yes, we have. We've got one more question, I believe, and it's just a follow-up from Victor, who was earlier asking about what a Czech company was. I think it was just a simple miscommunication. I think, Victor, that you just misheard our friend Mark. What he said actually was tech companies, as in technology. So right. I hope that clears up any confusion that you may have had. Mark, other than that, there are no further questions in the questions or chat windows that I see here. So if you'd like to wrap this up, I think we can go ahead and do that.
Well, first, Rob, thank you very much for the people at Lightspeed asking me to come on. I sure appreciate it. I thank all of you who came. You had some great questions. We actually had a reasonably good group, and I hear we'll have many more views after we're done with this. And December 9th, come on back December 9th, and we'll try to recap 2020. Then we'll try to forget all that. And maybe we can take a little peek at 2021 and see where we stand in December, getting a little closer to the new year. So you all have a great day. Thanks, everybody.
Thank you very much for your time today, Mark.
Okay, my pleasure.
Take care.
You too.